Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Seb Wallace of Triple Point to talk about the Triple Point Venture VCT. Hi Seb, welcome back to the studio.
Thanks for having me back, Jonathan.
No worries. So for those who aren't familiar, the Triple Point VCT, what does it aim to do for investors?
Well, first and foremost, we're aiming to hit a dividend of up to 5% annually with steady and ideally growing NAVs, but try and do it in a slightly different way to other VCTs in terms of the companies we invest in, the way we invest, the stage we invest, and the diversification of the portfolio.
Fantastic. And I guess we'll touch on that later, but just for now, Triple Point Ventures, who are they and what's your role there?
Yeah, so me and three other guys started the ventures business within Triple Point back in 2017, 2018. I mean, Triple Point's been going since 2004, and we started with the VCT actually in the limited life space. And then after the patient capital review, alongside our asset classes, we had a VCT, and me and two other individuals set out to sort of begin investing in venture capital. My background being previously an M&A lawyer and after that having being an entrepreneur myself. And so that was really where we began. And we had an EIS, and then we moved on to VCT, and now the VCT is our main flagship fund.
And so what are you looking to invest in, and do you have any recent examples of companies you've backed?
Absolutely, yeah. So we're very focused on investing in businesses at the seed stage, sort of almost always less than £1 million of revenue, sometimes as early as teams pitch decks and fantastic ideas. We're really focused there. Alongside investing in only exclusively B2B companies. That combination of going slightly earlier and focusing in B2B is really what I think differentiates us. We're also very diversified, 54 companies, £93 million. I believe on a per £1 million of AUM basis, we're potentially the most diversified VCT that's reasonably mature, at least past the 5-year mark. And we're really exclusively focused in those areas. We're sector agnostic. So, for example, we've got businesses like Nory. They recently announced their Series B round, led by Kinnevik, previously invested in by Excel, and that's restaurant management operation software. And they've been doing phenomenally well, obviously, but you can look at that in one sector, and then you can see businesses like Scan.com that we invested in a few years ago in the medical imaging infrastructure space. So, very different sectors, fundamentally really acute needs, improving margins or improving services or improving service delivery. But very, very diversified. And then if you look at like newer businesses we've been investing in, you've got businesses such as Lateral, which is focused on the underlying insurance infrastructure in private medicine, which of course is increasing in prevalence in the UK. Or businesses like Geek, which are focused on the shift to net zero within the household, such as installations of heat pumps and the automation of the design of what needs to happen around that, and obviously facilitating installation easily through technology. So a real variety, and the idea of being sector agnostic is that we are approaching the most interesting opportunities relatively fast. We're not hemmed in by saying we only do this. I mean, we're very exclusively or almost exclusively at that earliest stage, but we're quite broad in sectors. In fact, over 20 sectors.
And so what is it specifically that you look for in a company? What is it that piques your interest?
Yeah,
it's a range of sectors, isn't it? You're not focused on just
exactly.
one sector.
I mean, first and foremost, like it sounds trite, but the team is very important. The expertise, I like to call it the leverage of the team. So the ability of the team's like historic expertise in the space they're building in or in another space that enables them to go to market fast and to validate their hypotheses fast. That's normally a good indicator of their long-term ability to grow, but it's also ability to get from 0 to 1. That's the first thing we're focused on. But we spend most of our time actually doing a lot of research around evolutions in markets. The last couple of years, you can imagine, has been frantically busy looking at how things like AI are going to change the world and how they're going to embed within businesses in B2B technology. And we will do a lot of research. We'll publish that research. We'll outbound. We'll try and reach out to founders operating and building in the spaces that we think are interesting, and then try and do deals like that. So that's what facilitates our ability to invest across sectors, and we're very reliant on our research ability and the ability to reach out to those founders ourselves, rather than necessarily having them come inbound. We do have some inbound, but I tend to find that the outbound quality is higher. We can control for it better. And so that's really where we're focused.
So your recent investments, most of those are outbound?
Yeah, actually a combination, but yes, like I'd probably say about 70% of our deals are outbound. Okay. Obviously, as you grow and you have a portfolio of founders who you think are, are good and perform, and nothing's better than that sort of referral. But and we certainly look at inbounds because there's opportunity there, but the outbound opportunities are more controlled. You can understand what you're getting into a little bit more, and also you have a faster time to decision. When you're meeting a good founder, you often need to identify that opportunity and put an offer on the table relatively fast, particularly in this current market where you see across the market deal volumes go down, but deal values stay static, which means a consolidation into high quality deals. That ability to have time to decision, very important. And that ability to do that comes from outbound origination and really doing that research beforehand so that when you're talking to them, you're on the same level.
Yeah. And what's the split between new investments and follow-on? Because you invest at a very early stage, which means a lot of your companies go on to raise future funding rounds. They're quite capital hungry. What's the rough split now?
Yeah, so you can imagine as the VCT's been growing, that split's been growing. Historically, it was circa 30% follow-on, 70% new. It's now around 50-50. Probably because of that earlier focus, it may go over 50-50 in time. Not at the moment, may go over 50-50 in time. That's a good sign. It's a sign of us wanting to maintain our stakes and to help those companies grow. These companies, when we invest, they will typically take on another investor at a subsequent funding round because we are specialists at that earlier stage. So it's not that we provide the capital for them to go from 0 to unicorn status, but we are absolutely focused in that sort of that gap when you're going from 0 to 800-900K of revenue annual. That's a real challenge. That's the breakthrough moment, and we're focused there. And then we will hand on, obviously, still be close to the companies and be receiving the information rights, but hand on to the next investor, the next stage investor.
So I think that's happened quite a lot in your top 10 recently.
Yes. In fact, like I mentioned, we mentioned Nory, but to be honest with you, our graduation rate, which is the rate at which the companies we invest in go on to a subsequent funding round, go seed to Series A, for example, is around 3 times higher than the market average. It's a great sign. I think when you have a portfolio where the average hold period is 38 months, which is what ours currently, the VCT's in its 7th, 8th year, but the average hold period is around 38 months. You're looking for those indications of success, and that ability to pass on to the next round is often a good indicator of success. It's the closest proxy you can have to validation externally. Obviously, commercial growth is the be-all and end-all of it all, but the extra money is indicative of future potential.
And then, Seb, I guess the ultimate destination is an exit. It's the ultimate mark of success. Now, over the past couple of years, we've seen the exit environment pretty subdued, probably an understatement.
Yeah.
What does it look like today, and have you had many exits in the portfolio?
Certainly. I mean, you are totally right. 2022, when those rates went up, the world just recalibrated, especially after 2020, 2021, which was a pretty crazy period. Actually in that 2022 period, we exited a business, which, we've talked about previously, to Apple. But absolutely the exit market went down considerably. In fact, I think about a year ago, it was at the lowest in about 14 years, which when you think about the amount of private capital that's been deployed in that period, per pound of deployed capital is very low, maybe even the lowest ever. But we are seeing some encouraging signs. We are seeing our portfolio companies receive more interest. Our average hold period is 38 months at the moment. So we're holding businesses typically for an individual company for 7 to 10 years because we're going at that earliest stage. So we're not expecting a large deluge of offers for our companies based on where they are right now on the average maturity. But there are a couple that are more advanced, and we are seeing that interest. In fact, actually, it's a very interesting opportunity because there's also quite a lot of capital willing to fund privately the next stage at those later stage businesses. So they often are having now options of, do I raise more money, or do I exit? Do we create some liquidity? And I certainly think in the next year, 2 years, we'll see some stuff that's more interesting. We have 5 exits that we've been able to, where businesses are underperforming. I think it's very important to be able to liquidate those holdings because you can reinvest that money into better transactions, better deals. And we've seen that being able to be done much more regularly, much more actively in portfolio management in the last year. And then we've had 2 profitable exits, but we would expect to see some more of those in the coming years.
Oh, very good. So Seb, turning to risks and the risk within your VCT, you tend to go much earlier than other VCT investors when you make an investment, but then your portfolio is broadening out. So how do you describe the risk of this VCT to investors?
Yeah, so on an individual company basis, like it's absolutely true that each individual company is higher risk because you're going earlier, and so you've got fewer indicators of success. But at the portfolio more broadly, like at the portfolio level, which is what our investors get access to, new clients get access to, we're diversified in sort of three ways. First of all, we are, as I mentioned at the beginning, we are, I believe, the most diversified per £1 million of AUM in the VCT market, in the established VCT market. 54 companies in 93, at the time of recording, at the £93 million of AUM. But alongside that, we also have two other elements. We've got obviously the deep sector diversification. At 20 sectors, you have to ask, it's getting a little bit academic there. Like, are two sectors even two sectors, or are they one merged together because they overlap? So there's lots of subjectivity there. 20 is very diversified in sectors. But lastly, because the VCT has been evolving for the last 6-7 years, somebody coming in today is not just getting access to early stage deals. They're getting access to, in fact, over half of our portfolio, about 54%, is held in companies that are post Series A who are maturing and growing. So the hopper, so to speak, is being filled with new companies that are younger than the hopper in other funds, but we absolutely do have quite a diversification in terms of age and maturity and progress of these companies. We have 6-7 companies that are valued at material valuations, hundreds of millions, etc. So it's not all the individual company story of it being high risk, because at the portfolio level, we're more diversified in age, sector, and number, which means that we're delivering a similar outcome for a VCT investor, but in a different way.
Ah, very good, Seb. And so to sum up everything we've just discussed, for those that are looking to back a VCT this year, why should they be adding Triple Point to their portfolio?
I think it's a great VCT to add to a portfolio because we're constructing the underlying VCT's portfolio in a different way to other VCTs. More diversified, younger companies, diversification in several different ways, delivering the same objectives you would expect from other VCTs, but in a different way. And so it enables you to have underlying diversity of strategy in your VCTs, the same way that in an ETF, you might have a NASDAQ and a FTSE. Like in a VCT, you might have a later stage VCT and a Triple Point VCT. And so I think that it's a really valuable place in people's portfolios for that reason.
Oh, very good. Seb Wallace of Triple Point, thank you very much.
No, thanks for having me.
If you're watching on YouTube, please press like or subscribe to the channel for more.